In Singapore, we've had unprecedented demand for physical gold bars, gold coins, silver bars, silver coins. There's like 10 times more customers on the buy side than usual. And with the coronavirus lockdown around the world, that's created shortages in the physical supply chain with mints and refineries.
Hello there, my friends. Chris Mark is here with you for Arcadia Economics. And as the insanity on the LBMA and the COMEX continues to get ramped up, I'm quite excited to have a new guest to the show, although someone I'm guessing you're probably already familiar with. That is Ronan Manley of Bullion Singapore, precious metals analyst, who's really had some incredible reporting of what's been going on the LBMA, as well as the COMEX and a ton of other things in the gold and silver markets, which fortunately we're going to dig into today. Real quick before we get started, hit that subscribe button and the notification bell, because then when I'm fortunate to have great guests like Ronan on, you can know about it first. And with that said, long intro aside, Ronan, great to have you on here today. How's everything going with you?
Great, Chris. Good afternoon. I've been really looking forward to our chat. I know that we were trying to schedule it last year, but it's finally happened. So I hope everybody will get a lot out of this discussion today.
Well, I have a feeling they will, and interesting the way life works out, because probably couldn't be a better time than now. Maybe to get started, we can go back in time to somewhere around last week where we had the LBMA issue a liquidity warning. Seems like they're trying to kick up a game of musical chairs with different size gold bars floating between London and New York, although I don't know if they've figured out how to get the gold bars from spot A to spot B. But why don't you give an overview of what's happened in these past week or so for folks?
Well, it's been unprecedented both in the physical markets and in the paper gold markets. In Singapore, we've had unprecedented demand for physical gold bars, gold coins, silver bars, silver coins. There's like 10 times more customers on the buy side than usual. And with the coronavirus lockdown around the world, that's created shortages in the physical supply chain with mints and refineries. For example, the Royal Canadian Mint has closed down for 2 weeks. The big mints, the big refineries in Switzerland and in the south near Italy, Pam, Valcambi and Argo Herreras are closed down for at least a few weeks. So the unprecedented physical demand caused all of the dealers and wholesalers and mints and refineries to sell out completely. And they had to start production again. But because of the shutdowns, a lot of places weren't able to start production, and a lot of logistics companies weren't being able to deliver physical precious metals. So what you began to see was huge premiums on physical bars and coins versus the paper spot prices. These premiums were extreme in silver, still very strong in gold, and even to an extent, buyback premiums where dealers were offering above spot to buy back bars and coins because they wanted to top up their inventory. Like Bullion had predicted this problem a few years ago, and we always held a lot more inventory than we needed. So we still have a lot of inventory, but other dealers are completely sold out. So what you began to see was last week and the week before was a huge divergence between physical prices as dictated by physical demand and supply and the paper prices on the markets that come in from LBMA trading in London and COMEX trading in New York. So that was one type of price divergence, a physical and paper disconnect. What we saw last Monday morning was something entirely different, but arguably even more important. And that was that the spot price in London was diverging on the downside away from the futures price in New York. So for example, The spot price was trading at 16.10, and the futures price on Monday afternoon was like 16.50, 16.60, even up to 16.90 at some point, with a $90, $100 spread between London and New York. And at the same time, the two-way spreads, bid-ask, of the London market makers, who would be banks like JP Morgan, Goldman Sachs, UBS, HSBC, those spreads diverged by $100, say, for example, 15.20 to 16.20. It just didn't make any sense. So then what happened as mainstream media started commenting on this Monday the 23rd, Tuesday the 24th, the LBMA came out with this unprecedented statement where they said that they supported CME and the COMEX in New York, and that the problem was due to volatility of futures prices in New York. So basically they were saying, don't look at London, look over there, look at New York. So they were seemingly shifting the blame across to London, across to New York. And then that triggered off a whole series of very bizarre events, nearly on a daily basis over the last 7 days, really. So one, you've got the LBMA and the CMA colluding, and they're saying that they will support the global gold market, whatever that means. The next day, CME came out with a statement, very surprisingly, and they said that they were going to launch a new gold futures contract, which would allow delivery of 400-ounce gold bars. And these gold bars are the ones that people will be familiar with from photographs, the big central bank gold bars, which sit there in vaults. Probably they're nearly too heavy to lift, and they don't go anywhere. They just stay in central bank vaults.
Right.
So it was never a case that the COMEX dealt in any of these central bank gold bars. COMEX GC100, the famous gold contract, can theoretically physically deliver, although it's rarely physically delivered, but it can deliver in 100-ounce bars that weight, are kilobars. So here you have the LBMA coming in completely left of stage and saying, we can now help the COMEX launch this new contract with a 400-ounce bar, which doesn't make any sense whatsoever. Then bullion banks started feeding information to journalists like Reuters and Bloomberg and the Wall Street Journal, in fact. And then you got these articles coming out, and they were saying that the reason that there have been problems between the prices in London and New York were that bullion banks couldn't find enough flights to send gold to New York. But that's complete garbage. It doesn't make any sense. London banks never send gold to New York. They never physically send gold to New York. I looked at the US imports of gold from the UK, and there's zero. There's no gold. They never do that. The local London is a system where gold, which isn't actually real gold, it's unallocated gold, settles and clears in London. It's basically unallocated gold on top of an inverse pyramid of a little bit of gold in vaults in London. So this was total smoke and mirrors by both the LBMA and the COMEX. So I wrote an article about that, just kind of saying what was what. And there have been reports in the market that the real reason behind the blow up in the spot price in London was that bullion banks have been short a particular product called EFPs, exchange for physicals, which is a mechanism by which the COMEX gold futures contracts can be passed off for delivery to London using unallocated gold. So it's not actually real gold. And the rumor in the market was that some of the bullion banks suffered huge losses. And this is what caused the whole spot market in London between the market makers to freeze up, because they didn't trust each other and they didn't want to be quoting to each other. And I saw some tweets from the headline Gold Money alluding to that last Tuesday. But then nothing was said by the LBMA or the COMEX. So if that is true, then they're obviously wanting to keep it under wraps. So when it became known that there was a launch of a new 400-ounce gold contract on COMEX, I did a little bit of digging and kept my eye on the gold reports from COMEX that you see coming out every day. A lot of your listeners will probably be familiar with this COMEX gold report, which lists approved vaults, or what they call warehouses, in New York and surrounding areas. So basically it has registered and eligible gold that sits in vaults approved by the COMEX, including Morgan, HSBC, Scotia, Delaware Depository, like Lomas, Brinks, and a few others. So very strangely, on Monday of this week, when the report came out, it contained a new category. So it had the normal list of each vault, and under the normal entry on the Excel spreadsheet, it had a similar entry with a line heading 400-ounce bars. But under all of these vaults, they had their 400-ounce category, and there was 0, 0, 0, 0, 0, which means that they didn't even have any 400-ounce bars in New York. And I wrote a quick blog about that and published it, and then put it out on Zero Hedge as well. As soon as it went out on Zero Hedge, the CME people took down that Excel spreadsheet that had all the extra lines about the 400-ounce bars, and they put up the old version, which didn't make any mention of the 400-ounce contract. And the same day, the LBMA came out with another statement, and they said that the LBMA and the CME want to reiterate the healthy nature of gold stocks in London and New York. So this to me smacks of desperation. They seem to be panicking. They probably got people in New York and London, big investors, querying, can they take delivery? Can they allocate London gold? Maybe they got word of people that are trying to stand for delivery on the COMEX. And it also reminds me of the 1968 central bank gold pool in London, which was the Fed and the European central banks, Bank of France, Bundesbank, Bank of England. So basically, back then they were trying to keep the price of physical gold at $35 an ounce, and they just kept selling gold until they didn't have any more, and the London gold pool collapsed. But back in November, December 67 and January, February, March 68, they were coming out with statements saying, we have a lot of gold, no need to worry. Exactly what the LBMA and the CMA are doing right now. It's like history is rhyming, it seems. So this new contract, it's called GC4, this is from the GC100, is being launched on Sunday night Asia time, like Sunday night US time, but Monday morning Asia time, because it will start trading on the CME platforms on Monday all through the week. And I know, Chris, you found it quite amusing that strange mechanism within this new contract, where in the FAQ section and in the kind of regulatory reports that they have to submit, they make the very obvious observation that you cannot use a 400-ounce gold bar to settle a 100-ounce contract, because they're not, for whatever reason, they're overlaying the 400-ounce contract on top of the existing 100-ounce contract. So with the 100-ounce contract, if in like 1 in 10,000 cases, somebody does want to get delivery, they can get delivery of a 100-ounce bar or 3 kilobars. So what they're saying now is that they can use a 400-ounce bar to somehow get delivery of a 100-ounce contract. But obviously that isn't possible because a 400-ounce bar can't be divided. So what they've come up with is this new paper like idea, concept. It's called accelerated certificate mechanism. I have to double check. It's called accumulated certificates.
It's hard to keep track with these buzz phrases they come out with on almost a daily basis.
So yeah, it's called aces. So actually, it's as if they're holding all the aces, just like a game of cards. It's called accumulated certificates of exchange. And what these things represent is that they say that if a vault has a 400 ounce bar, the vault in New York can issue 4 aces, each representing 100 ounces. And instead of getting delivery of a warrant representing 100 ounces, you're going to get delivery of 1 ace. But to actually convert these back into a bar, you need 4 of them. So basically, they're adding another layer of paper upon all the existing layers of paper. It's incredulous in one way that they're able to get away with it with a straight face. So the statement that came out yesterday, the second statement in a week that came out from the LBMA and the CME about their healthy gold stocks, they said in London there's 8,600 tons of gold in the vaults in London. And these are the vaults of JP Morgan, the Bank of England, HSBC, ICBC, Standard Bank. But what they're not saying is that if you take that 8,600 tons, and if you take away central bank gold, which is about 5,700 tons, and if you take away gold held in these vaults on behalf of ETFs, you're left with less than 1,000 tons. So the people in the gold industry sometimes call this the float. So the float of gold in London is less than 1,000 tons, propping up the whole edifice of the paper gold pyramid. And what's happening now is that LBMA is saying with a straight face, we're offering CME in New York, COMEX, a bit of this kind of a foundation stone, which is just propping up the whole house of cards. And in the same statement, they came out and said that there's a lot of gold in New York already eligible and registered. And so basically, there's only 287 tons of gold in New York, based on yesterday's report. More than half of that is already registered for warrant holders who previously had kind of wanted delivery of a warrant. And the rest, which they call eligible, all that means is that there is gold in those vaults in the form of 100 ounce bars or kilobars, but that could belong to anybody. That has nothing to do with COMEX. That was just gold that the COMEX vault managers have to write down as being eligible because it happens to be in their vaults. It could be belong to refineries or mints or jewelry companies or anything. So it's like a magic show of Penn and Teller where they're saying, look over there, don't look over here.
I was thinking the Three Stooges, but...
Well, if you included the New York Fed, that could be the third member of the Stooges.
Yeah, it's incredible what's happening. And Ronan, you mentioned the London gold pool, which for years I've wondered if we weren't headed towards the second occasion of that. For folks who aren't familiar, the London gold pool was the arrangement we used to have until the U.S. started spending money, guns and butters, and eventually other countries were draining the gold. And that took us from $35 gold. For all those folks who say, well, stock markets are destroying gold, keep in mind we had $35 gold 1971, and as the demand drained that, we've gone from 3,500 to 1,600 and change. Do you think that we're watching the unraveling of this system right now? I mean, I guess you gave us the LBMA official version. Now I'm curious. All right, so that's all the nonsense they say. Do you think this is actually unraveling as we speak?
Well, I think that the market needs a higher gold price, and that is being indicated by the unprecedented physical demand and the fact that the supply can't keep up. Some of these Reuters, Bloomberg articles were saying that the supply shortages are due to coronavirus shutdowns. That's true to an extent, but most of the shortages are due to the fact that demand was so high that it cleared out the dealers, the wholesalers, the mints and refineries, all the way back through the supply chain, and even probably back to the miners. You'd know more about the mining companies and how they interact with the mints and refineries. But so demand pulled all the existing supply, and the supply wasn't able to keep up. And the physical prices which are being created as we speak all around the world, if you look at APMEX, MONEX, in the wholesalers, Dillon Gage, AMARC, and even in Bullion Star, we can see our own market where there's demand and supply. These are real prices. They're nothing to do with the fake prices coming out of London and New York. So for years and years, the paper gold system of unallocated gold in London, which is basically synthetic fractional gold, which is a liability claim against a bullion bank, and the futures in New York, this has been suppressing prices. So there is a lot of gold in the world. There's nearly 200,000 tons. But for that gold to be mobilized, it needs a much higher price. And these investment banks and the central banks that oversee them, the regulators, they've all been guilty to an extent with allowing this to continue. I mean, it's completely crazy that in the biggest financial crisis for 100 years, probably, the gold price in US dollar terms hasn't done anything. It doesn't make any sense. It's an international disgrace. And the media are compliant with it by not even questioning it. Like gold has made new highs in nearly all other currencies except the US dollar. And now you got these, in some ways, clowns, stooges, LBMA, COMEX, coming out with these statements that are not even truthful.
Yeah, and it's incredible, especially we see this happening at the same time, Department of Justice doing an investigation into the precious metals markets. And I can only wonder, has it even come up in the conversation that here again, similar to 2008 and other times, we have a surge in demand, shortages, mints, refineries getting shut down. I'm not sure if you probably saw this news yesterday. Mexico just shut down any non-essential industries, of which they include mining.
So I didn't see that. That's big news.
Yeah, in fact, Jeff Clark of goldsilver.com had a great article yesterday where he went through some numbers. He calculated 30% of the silver supply is offline, but that did not include China, which has some vague numbers. He thought it was between 30 to 50%. I've heard similar numbers from Keith Neumeyer, First Majestic, was saying 25% offline. Some miners thinking about withholding their production. So it's like, I wonder if Department of Justice puts these together and notices that something unusual is happening in the market, because when you think about these conditions you're describing, this would typically be the time where gold and silver are soaring.
Well, I think that the regulators and the central banks, are so embedded into the problem that they either turn a blind eye to what the bullion banks and the wholesale market, the paper market is doing, or else they condone it, they're supporting it. Because there's been so many things wrong over the last few years with what the LBMA in London has been doing. They never opened up the gold fixing, the old gold fixing, which was discredited. When that was transitioned to the new LBMA gold price, it was the LBMA in charge of it. It was JP Morgan and HSBC continue to be in charge of it. The guys who were being sued in US class actions in New York. And the Bank of England and the Financial Conduct Authority, they know about this. They sit on the board of directors as observers of the LBMA board meetings. And the same with the Fed. The Fed and the CFTC and the OCC, they know exactly what's going on with COMEX and the fact that it's never delivered. And like this new 400-ounce contract is like a bunch of kids playing football. And when one team is losing, change the goalposts. Yeah. And they pick the ball up and they want to go home. Because they quickly changed the rules of how physical or these contracts can deliver by putting a new layer of these accumulated certificates of exchange on top of them.
That's
So
American finance for you.
Well, exactly. The Fed bailout of the bond market, mortgages, municipal, commercial paper, that's all changing the goalposts. I mean, a bunch of kids wouldn't be allowed to do that in a school game, but they're doing it every day.
So that was part one of my interview with Ronan Manley of Bullion Star. Pretty wild, and especially coming from someone so well researched. So if you enjoyed that one, definitely hit the subscribe button and that notification bell so that as soon as part 2 is released, you'll be able to check it out.